All right, we are back, guys. Today's actually a really special day. We have a guest on that has a podcast that is much larger than ours. Obviously, it is phenomenal to have you here today. We only have half the group today. It sounds like Nick wasn't able to make it, but Dan, absolute pleasure having you on, man.
Yeah, happy to be here. Probably better that Nick's not here, and then you can get another episode with him
sure,
once
yeah,
he's
we can
figured
milk
out
it
whatever's
twice. That's even
figured out
better.
whatever's
Yeah.
going on with his belly there.
More
Yeah.
episodes with you guys. More likely, Equitable Bank might sponsor us if you're listening.
Yeah, there you go.
No, it's great to have you on. You are always posting, information about the current market, what's happening, keeping people up to date and what's going on. Your podcast is pivotal to investors and people across the country learning and understanding what is actually happening. And the thing I love about it really is you touch on economics. You touch on data and real things that are moving the market in a way in which the average consumer hasn't seen. The average, realtor, let's say, 5 years ago, wasn't giving any sort of statistics or didn't look at the market the same way you do when you're actually reading the reports and you're talking to the people. Massive, breath of fresh air when it comes to the information that is coming out. Why don't you tell a little bit about people if they don't know who you are, what you do, how you do it?
Yeah, Daniel Foch, host of the Canadian Real Estate Investor Podcast. My real job is that I'm the chief real estate officer at Valery.ca, which is Canada's first AI real estate brokerage. I spend like the majority of my time researching the real estate market to determine what's going to happen and what is happening and give people a better understanding, kind of a lay of the land so they can make informed decisions, which I think is sort of the primary function of a realtor, actually.
Absolutely.
Yeah, and I was never like I was actually really a lot more of like a micro guy until COVID. So I would just look at you do your local market reports city by city and look at the data, what was happening there. But I realized like as COVID started to take hold and monetary policy really became a bigger theme, was the micro mattered a lot less. The supply and demand imbalances, the money supply imbalances were so significant that it wasn't really driving the market anymore. What was driving the market was macro. And that theme is still true today, I would say. I hope we'll get back to a market where micro ends up being the more important component. But for the time being, I think, global macro, money supply, credit availability seem to be the key driving forces. And I guess economic growth and population growth seem to be the key driving forces. So that's kind of how I ended up getting to that world and really bringing that into real estate in a way that, I would say like not really anybody had done at least in Canadian real estate until maybe Steve Saretsky, actually, to be honest. I completely ripped Steve's like game off, actually.
Thanks, Steve.
Yeah. But not in the Toronto real estate market. Like I basically just did what Steve did for the GTA, which is a much bigger market. And fortunately, it appears like a lot of people are now doing that and trying. Some really suck at it and the conclusions are horrible, but that's okay. Like they got to try, right? And I think the awareness that people have towards the economy and how it interacts with housing is probably higher than it's ever been. So that's cool.
Well, that is the knowledge gap, right? Like that is the missing piece of where like the average consumer investor, they just see the reactionary of investors with the stuff on TV, right? Like rates are up, rates are down, prices are falling or whatever. And they have that emotional reaction to it. But, the knowledge gap that is the industry profession, like this is the reason why it's happening, right? And, if you can start to learn the macro pieces and understand how that translates to the micro and how that's going to translate into the real estate cycles, like that's just going to improve how much better of an investor you are, because you can start to understand the reasons why things are happening, right? And once you start to understand it, I mean, that's when you can really actually put that into use and take advantage of it.
I think like contextually as well, people will spend like hours and hours like negotiating on a deal for like 2% or 5%, or they'll like negotiate with the realtor to save 1% or whatever it is. Maybe they'll change some operational things to scrape at the margins to get like maybe a 1% improvement on their ROI. Whereas, understanding the macro properly and like just timing market forces, whether or not it's a good time to buy right now, when there might be a better time to buy. Things like that can easily give you a massive competitive advantage. Like, I think significantly larger than pretty much anything else you can do in the micro. And so that to me is like why it's becoming very, very popular, is like, hey, maybe I should just wait to buy because I know rates are going to go down and I know prices are going to continue to go down. So maybe I'll save my acquisition till the market's chilled out and I'm not competing with all of these idiots who are still high on cheap debt, right? And then you do that and you have a massive competitive advantage over said people, right?
I feel like your understanding of the macro like gives you more advantage in your margins on either side of a deal, right? I mean, like you have your centerpiece, which is going to be like where your deal is going to fall the majority of the time, what your ROI is going to be, whether it's 2% or whatever those numbers are. But if you can understand the market cycles and what's going to create these trends and how the economy is working, well, you get more room on your margins. If you can pick it up cheaper, you can exit out at a later time or an early time, depending on what it is. Like having those margins. I mean, realistically, that's where a lot of the like additional profit is going to be made, right? I mean, if you really want to be successful, you want to be to make it easy, out trading or outperforming where the average is going to be, and the average is within those margins, and then on the exterior side of the margins is where you're above and beyond is going to be made, and that's where you have to come in from the economic and the data and understanding it's not just Canada, it's what's going on in Russia, it's what's going on in the Ukraine, it's what's going on in the States, it's it's what's going on everywhere, and that's going to all have an impact on your ROI.
It's like institutional level, almost, I don't say underwriting, but like understanding, and the average investor out of necessity now has to understand these macroeconomics that are moving markets. And when the debt you're looking to take on is all bond based, now more than ever you have investors who are trying to understand how bond yields work and how certain market trends are going to affect your yield over the long term when you're looking to take on long-term government debt. And I feel as though the sophistication of the average investor is looking for more. To be able to succeed in Canada now, it's no longer just buy the thing, wait, and then maybe make some money in the future. It has a lot to do with just fundamental understanding of how to do or how to execute on macro trends. And it wasn't something that was really even apparent even like three or 4 years ago.
You didn't have to understand.
Yeah, well, you didn't though.
It was just a different market.
Yeah. No, I think that the new investor, the modern investor, does understand these concepts and starts to understand and invest with these trends, and what you're doing about showing statistics and understanding GDP, how that affects things, overall growth. A lot of the times investors, I guess they didn't need to because they weren't holding the bag, and now they're holding the bag and they're wondering why the economy is the way it is. But the ones who win are going to be the ones who fundamentally continue to talk about these specific metrics.
For sure. Yeah. I think you look at, it's funny because a lot of people will come to me and they'll be like, oh, like Warren Buffett doesn't believe in like macroeconomics. I'm like, Warren Buffett's like a brilliant economist. Like he literally is, like, that's why he doesn't believe in it, because he doesn't need to listen to anyone else on economics.
He's over-understood it.
Right. Yeah. Like, he'll describe all of these factors and I'm like, yeah, that's economics. Yeah. Right. Like, and so it's funny from my perspective. Nobody goes into investing, I don't think, to say like, I just want to be average, right? I want to have the average return. And so if you want to outperform the average, you have to have some sort of competitive advantage. And I think one of the easiest ones to have is a better understanding when it comes to the macro. A lot of people have kind of like gotten more into it because of risk management, like you were saying, retroactive risk management, which unfortunately is a not really easy way to manage your risk. But I think the big thing, like Morgan Housel's Psychology of Money, it's like one of my favorite books, and he talks about a lot of these phenomena, how we never learn to deal with these issues because they never existed in our life, right? So like I remember growing up and my dad would always talk about inflation, and I was like, what are you talking about? Like, this is the dumbest thing I've ever heard.
It's not a bullet pool, Dad, it's an in-ground. What do you mean?
Yeah. And then, but then it came, and I was like, kind of prepared for it because I had like understood it because of that, like hearing about it for 30 years. But I had no idea like the actual impacts of it. And so our generation grew up without ever actually thinking about inflation, like ever. Right. And
2% is just a weird thing.
Yeah.
The Bank of Canada does these things like no one. Yeah.
Ignorance is bliss as a child, right?
Right.
Like,
and then you have kind of the same thing with interest rates, right? Like interest rates being rising in response to inflation. It's like, well, you could have been an excellent investor for the last several years, and because money supply was increasing and interest rates were going down, you never had to underwrite, oh, will this deal survive if I have to renew at, 100 bips higher after 5 years? Because that never happened. It literally, we were always renewing at a lower rate since the 90s, basically, right? Save for like maybe a couple of little
30 years.
Yeah, basically 30 years of declining interest rates. And so now all of a sudden we're hit with this like, oh, wow, things aren't the way that they were. And people are really rushing to try and figure that out because it's not like people want to give up on investing in real estate.
No, we feel the pressure on the mid, and I'm sure you guys do from your end in your conversations, but like that like sound wave of pressure is there. Like
for sure.
There's always a FOMO around the mid level of like, am I missing out? Like I need to get in the market. Like it's no matter where the market cycle is, that pressure's there. Like I feel it all
Canadians
the time,
are also drunk on the profits of real estate too. You take a look at, it's probably the best performing asset in the country for the last 30 years. All the baby boomers bought houses and they're now millionaires because of it. Like, there's this like underlying thought that real estate will continue to increase. And we have one of the hottest real estate bubbles in the world, and we'll call it a bubble because that's exactly what it is. You print more money, asset prices increase over time. But like, there's no lack of people who are looking to continue to invest in it. And I think the fundamental like understanding of like the M2 money supply and the fact that money will continue to enter the market, and it has to. If you have inflation, you have to increase the money supply to make that happen. Asset value will always increase macro over time. It has to, unless you take money, dollar bills out of the system. So I think more people are starting to understand like the long-term effects of like the system that we're in right now. And you obviously have people coming and talking about, well, what happens if the system, obviously reverts to something else, probably Armageddon. So that's a different story. But I think the fundamentals are going to stay the same. It's just how do you continue to purchase real estate at a level that makes sense and it's affordable or like qualifiable, I guess. And then that's where we've seen the biggest push in our business is the mid-sized investor developer. The retail investor who it worked for the last 20 years buying all these properties because everything with debt service, you'd have double the income on what the service would cost for the mortgage every single month. So the banks were just handing out money like it was their day job. But the second rates go up, rent no longer covers that debt. You have to find a way to be able to continue to scale. And that's where I guess where the conversation really started with the missing middle and developing this mid-sized space. I think that like all in all, that's where most investment or retail investment is going to flow in the next little, decade. Yeah,
I think so. I think there's it's a shame that the space didn't exist sooner because I think you could have eliminated a lot of the negative externalities that we're seeing right now that happened as a result of the COVID boom when you got a lot of like mid-cap developers or like small-cap developers who went from like building, maybe a 1 acre townhouse site to like their next project was like a 1 acre, like 40 or 50 story concrete condo site. And they're toast. Like a lot of those guys, right? Like you just can't see that they're toast right now. But like, if you go look at the land book on, any of the lenders in Canada, they're there and they're toast and they've burned through their interest reserve and everybody's just hoping eventually they'll be able to make themselves whole. Right. And one of the things that happens like in a recessionary period is you see like a lot of, maybe in the, let's use the US as an example, a lot of like M&A activity, right? So like, PayPal and eBay during the dot-com bubble after the dot-com bubble as an example. You'll see the same thing take place with big developers gobbling up a lot of these mid-cap developers because they never should have been taking on sites like that. And that site would be a better fit for that large-scale developer. And they'll take it and they'll finish the project and everything will be happy, or everybody will be happy except probably the people who purchased those pre-con units maybe, because maybe they probably would have benefited a lot if the project failed. But all of this to say, like, that mid-market was where the majority of developers existed. Nobody wanted to stay small custom home builder and nobody could make it to massive, the top 10 developers in the country, right? Yeah. The ones whose name everyone would know. And not all of them, but a lot of those folks are in really big trouble right now. And that's a big problem for Canada's economy.
Let's talk about that. I mean, I think a lot of people, like we have insight into things that a lot of people don't. People listen to your podcast, listen to our podcast to learn a little bit about, what is actually happening. what kind of trouble are we seeing? I mean, it's safe to say that condo projects are not selling.
Right.
And for anybody who understands or is listening, these guys take on massive construction loans, hundreds of billions of dollars, especially downtown Toronto. A lot of them are held by the big five banks, and they have interest reserves on these until you have lease up, and then lease up you would condo them off and you sell them and you close your project and make your profit. Well, that's obviously not what's happening right now. What are you seeing?
Yeah, I guess there's a couple of different challenges. I think probably like the biggest problem that we're seeing right now is that you have a lot of these pre-construction buyers who paid more than market value for what the units are worth today, and so they don't really have a high incentive to close, right? So maybe they bought in 2021 and they paid $1,450 a foot, even though market was $1,000 a foot at that point in time, and they were doing that because they expected that by the time the project was completed, the market would continue growing and realize that $1,450 a foot, and it didn't. If anything, it went the other way, and now you could take a brand new building across the road from that project that's about to close, and it would be worth $950 a foot maybe now. I mean, I'm seeing some in the low nines even in some of these cases, and so that person is basically lost 50 they've lost $500 a foot, so they've lost like a third of their equity.
And on a 20% down payment on 1,000 square foot,
Yeah.
Do the math, like you're out hundreds of thousands of dollars on a deposit.
Right. And so they would want to not close on that unit, probably. They'll get sued by the builder, and the builder will win, and they'll have to pay damages at a certain point. But a lot of them are choosing to close, and because they say, okay, well, I can lose $500,000 today, right away, or I can lose whatever, a couple $100,000 or $20K a year for the next 50 years or whatever, 25 years, however long it takes. And it seems like more and more people are choosing to do that, but you are still seeing a pretty high failure rate on the closing. So I guess the big risk factor is there a project out there where so many people choose not to close that the project can't actually condominiumize? And that I think would be the catastrophic failure that you might see one in the market, maybe. I don't know if you'll see many, but that could happen for sure.
Well, you've been seeing support from the bank side on these projects because from a bank's perspective, they would rather increase the ratio of potential loss or reduce the ratio of potential losses where you have one development loan that goes bankrupt versus you have 40, 50, 100 units that you lose 10% across 100 units is better than losing one giant construction loan, right? So I mean,
optically, then you're just basically taking the risk and spreading it out across hundreds of purchasers.
That's exactly what they're doing, right? And I mean, even though the value's not there, I mean, they're giving them the value on these properties, right? So I mean, it's
which is wild.
Yeah. I actually understand their incentive to do that
for sure,
because beyond just the construction loan, it's also like if you're a bank who will give the person the valuation on this, let's go back to the $1,450 a foot. Let's say that market value on that's $950 now. When is it going to be worth $1,450 a foot again?
10 years.
Yeah. So you've got that person for at least 2 more loan terms, right? Because they can't go and shop that to some other bank because no other bank's going to give them the valuation. And so it's, for me, it's a loss leader, right? They've probably done some actuary on it and said, this is a percentage that we expect to fail. This is the percentage that we expect to be good. And we know that, we know how expensive it is as a bank to get a new customer. So, and we know how valuable it is to keep them for 15 years. These are customers that we are guaranteed pretty much to have for 15 years unless the market recovers massively, which is everybody will be happy in that regard.
They can qualify, pay the mortgage.
And they do anything to pay their mortgage too. I mean, they'll...
Yeah, I think to a point, right? I think that there is... it all depends on equity, and this is why the government's really trying to keep equity where it is, right? But Canadian real estate is really an equity-based security. It's not based on people's incomes, and I think that's kind of like the part of us having a more full recourse environment than the U.S. Like that also allowed values to accelerate in kind of a silly way because in the U.S. banks had to underwrite the asset really well because they're like, I can't just or I can't rely just on the borrower to be the security of this loan. Whereas in Canada, you can, right? It's like, I have you forever. If you know what I mean? Or you have to go bankrupt.
Yep.
And so you're kind of less dependent on the asset being underwritten perfectly, I think.
So the condo mess, I mean, obviously you see everybody post. I'm huge. I love Twitter as well. I'm addicted. It's my favorite thing in the world. Or X, if you want to be official. But
Politically correct.
Yeah, of course. Kudos to Elon. But following all these doomsday posts, I think I see 10 a day. The same people just pushing the condo situation. Like it's a pretty dire situation. At the moment. Realistically, the bag holders that are going to be holding ththese loans, you're not cash flowing any of these properties unless you have massive equity positions.
Yeah.
How long realistically does it take for these condo markets to come back?
I'm of the opinion that the answer is never, but
I think the price point will never get back to where it was.
I don't think that, I think that if the price point gets back there, then rents will be you'll have units that'll service, and our capital markets are improving to the point where, or becoming accommodating to the point where purpose-built rental is going to be a far better play. I think that, if you look back at the decades of condo construction, there were so many negative externalities to the way that we delivered housing, and a lot of those are finally becoming apparent. So you've got, a lot of these condo buildings and curtain walls with curtain wall systems and mismanaged budgets, because it's a bunch of amateurs running the condo budget. Condo fee acceleration on some of these newer buildings that weren't built very well, that are making those highly illiquid. You've got absentee landlords, new landlords, people who didn't intend to be landlords because they wanted to flip the paper or whatever. And you've got thousands of these. So you talk about the stress on the landlord and tenant board. I mean, there's just as much put on it by bad landlords as there is bad tenants. Landlords who aren't running compliant businesses, et cetera. You go look at some of the delinquency rates. If you look at the concentration of rent delinquency by project, it's becoming more and more concentrated into these newer projects. So they're also, attracting tenants that aren't paying the rents. They're not subject to rent control, which, it's having a bifurcated market where you have some rent control and then not rent control creates some dislocations, obviously. I'm not a fan of rent control at all, but it's hard to have both models, right? 2018 plus is not subject to rent control. So I think that you've got, there's more and more problems, and then you've got basically, I think that the biggest problem is that it broke the way that we raise money for condominium projects or for housing projects. You go to the U.S., you get strong capital markets, strong equity markets. You want to build a high-rise building, you present that building exceptionally well. You go raise capital. Maybe you can crowdfund because of the Jobs Act, but usually not the right scale, anyways. But in Canada, you can't do that. You can't crowdfund. You can do some of the exempt market stuff or just your typical private equity raises. But that's that does take place. That's usually earlier in the capital stack. And then you basically get more equity by hiring a bunch of realtors. Functionally, this is what's happening. Indirectly, hiring a bunch of realtors who go out and say whatever they want about the project. Literally, I have ads screenshotted where people are guaranteeing returns of, X% and whatever, price is going to go up. This is the ROI, blah, blah, blah. So you have all of these realtors who it's just completely Wild West, unregulated capital market, basically. And they're out there gathering equity in the form of pre-selling these units. And those people are, the developers now can insure that deposit, and then it goes into their capital stack for them to get to construction financing. That that component probably is the most violent piece of the whole thing from my perspective, because that's where all of the collateral damage happened from people being promised things that weren't true, from people uneducatedly investing in projects, and they end up with the least profitable financial product, let's call it, in the whole capital stack. Had they been given the opportunity to invest properly, maybe at the beginning in a purpose-built rental project, the same amount of money, maybe even on the same payment schedule, they would have got a far better return. The developer would now have a professional manager on the building. The tenants would have a better experience. The market would be better. the equity investors would have had a far better experience. And so to me, there is a way better model out there for us to build high-rise housing, and we just need to get to it as fast as humanly possible, because what we did before is gone. Like you can't, and I can't see it visibly returning, at least not for a commodity product that would compete with large-scale purpose-built rental.
Yeah, I mean that shift, that like almost like a paradigm shift of like owner to renter is really just materializing in front of us. I don't think like necessarily the investors who were investing in those condo units really understood the opportunity that was in front of them. Like, nobody was building purpose-built rentals when you could sell condos off the shelf.
Yeah.
It was an easiest investment, you know, for
Well, from an
developer.
investor's perspective, I mean, there was, you know, whether it's true or not, but there was just so much upside. You know, hey, you can cash flow and you get all this appreciation from day one. Like it, you know, you get like a, you know, it's a double-edged sword in terms of like return and on the investment, right? And I think like in terms of just what you're saying in terms like, you know, investors getting into projects and things being like mismanaged. I mean, you know, we just had Ben on literally talking about, you know, condo fees and condo corps and how to structure it properly. And, you know, if you understand any sort of financing from a bank's perspective, they look at your, you know, your reserve and the condo bank accounts and what does that look like? And there's a lot of, you know, condos that are on lists of lenders that people don't want to get into. And if you're not doing it properly from the start, and it kind of turns into a little bit of a shit show and you're just kind of throwing everything together at the last minute, I mean, yeah, you don't create an overly profitable project. But I think even on the like the mid-level stuff that we're seeing from like purpose-built stuff, I think you still have to be careful there because there is still a lot of probably raised capital that's being put into these projects. And I think, you know, there's a lot of slight like misunderstanding on like the purpose-built stuff in terms of like what your ROI is and how the ROI is delivered to you and what your return is. And it's not, you know, there isn't that same like cash flow return that you get on a condo where you can sell and you actually get equity, like cash flow back into your pocket. Whereas on the purpose-built stuff, I mean, you get a huge equity piece that's built in there between the top of your construction loan and where the as completed is. And like we're seeing, or, you know, I've seen some projects where the developers are just squeezing out like management fees. I got a project I was looking at the other day and almost 10% of the budget was like management fees between the builder who was a partner and between the other partners who also wanted a kickback. And, you know, I think they're like the mid-level guys are kind of realizing like this isn't a true like cash return type model for like a liquidity return out of the equity.
It's an investment. It's not a business.
It's a long term. I mean, yeah, you can get some management in there, but I mean, you really do have to be careful how much management you're trying to squeeze out. I mean, the more management fees you build into your budget, the higher the loan, the higher the leverage, the less cash flow that you're going to take. You know, especially if they're going MLI, like a lot of investors are realizing that a 1.1 model really doesn't return a whole lot of cash flow to you. And if you have private investors that you got to pay back as well, how are you paying them back? Because you're not getting equity out at the end of it. So it's not like you're turning over an apartment building and, you know, creating a cash return on a refi. You're just getting 95% of your costs plus a little bit of management kickback. So I think, you know, like they really do understand the concept and what that looks like as an investment. And, you know, being over leveraged can be definitely very dangerous, even on the purpose-built side, because you don't have that cash coming back to you, like liquid equity.
Yeah, there's two things I would add there. Like on the 1.1 debt service coverage ratio, like I think you're seeing a lot of risk materializing in that. Like anybody who was underwriting at 1.1 last year probably is getting killed by vacancy or rents.
Yeah,
that just natural changes in the market on those. But the other piece that's interesting is like, you know, it makes me hopeful, like hearing that we're moving more towards a U.S. style capital market where like it matters who the GP is. Because like when you were buying a condo, it didn't matter who the builder was, right? I mean, kinda, but like there was such a high degree of excess demand for this type of product that basically people were lining up and taking whatever they could get, right? Like, and there was a scarcity mentality around like, I'll just grab whatever unit I can get. I don't care who's building it. Whereas if you're giving your equity to somebody, like you're going to look at the memorandum that they send out and evaluate those costs, like you said, and you're not going to work with a bad GP. And so, or you shouldn't, hopefully. But
yeah,
like
hopefully you're doing the research before you invest.
Well, I think that because like the equity markets are safer, like they're more regulated, you should be getting like proper capital advisory. You should be getting, you know, ILA, like and whereas like with these condos, like that wasn't happening. You were just like, oh yeah, my realtor told me. It's like, okay, cool, like that's a trustworthy character. So send it, like, you know.
Well, I think it becomes like touching on what Aaron was saying about how, you know, you're either max leverage on this stuff and you don't have any cash flow, but like these things are legacy items and they're quickly becoming out of reach for the average Canadian. I mean, it was hard back in the 70s. Yes, it was hard back in the 80s, but it's becoming more difficult and out of reach now for the person who wants it. And the person or the group of people who are acquiring these items, I think, you know, the risk you have to take to be able to do this now is significantly higher. You know, the leverage you're taking on and the external risks of increased vacancy, you know, increased costs on debt, the variability of markets in general. You know, it's going to push more people out. And where we're seeing is really wealthy individuals or groups of wealthy individuals using their capital to do this. You know, they're finding a return now long-term in good markets. It's very difficult for like a mid-sized developer just to go to an institution and cut a $1.5 million equity check. Like, they're not interested. So like this whole mid-sized stuff is just being financed by wealthy families who are looking to, you know, acquire legacy items for the long haul. And I think it's like a collection game up until the point when, you know, values go up again. It's going to become almost impossible. Like the urgency from the people that we're seeing doing this is like, they don't want to do one. They want to do a bunch. They want to do it now, because you kind of follow the bouncing ball as to where real estate will continue to go. You know, these are going to be almost impossible to build, especially if we're at 1.1 right now on a debt service with no cash flow, and the numbers are just making sense with, you know, you're talking 50-year ham government debt, like max leverage.
I think that needs to be like the focus of these mid-level investments, like less so some of the mid-level REITs and like capital firms who have, you know, the equity and the analyst guys, and they're a bit more like underwritten proof with that stuff. So I mean, they're a bit more safe. But on the entry level, you know, mid-entry level, like infill investment, like there needs to be like an emphasis of the investors being like, let me take a look at the documents, but also from the, you know, the borrower and the development side, like, you know, the game plan is this, you know, right now CMB bonds are risky. It makes more sense for us at this type of a project to take a 10-year than a 5-year because of, you know, renewal risk and where the bonds are at. And, you know, based on how these construction loans work, like, you know, that means you're probably going to be holding in with this project for 10 years with us, right? And from an investor, you know, is the expectation that at the end of, let's say, 18 months when the construction's done, are they getting paid out? Because, you know, there really isn't that, again, that process of being able to pull out all that equity and actually pay out the initial loan. So again, like, I think it's fine and the model works as long as the conversation is correct. And on both sides of the coin, I mean, investors obviously need to be doing their own due diligence on the projects and understanding the questions and understanding the financing and what is actually entailing in construction financing. But then the borrowers obviously need to be, you know, they need to expose the products as well too, and be upfront with what's actually going to happen, and not just, hey, you know, give us $1 million, you know, we'll get your money back at the end of the project. But what is the end of the project on a construction project, right? Like,
yeah, it's funny though. Like, I mean, a lot of these development projects where people are getting like involved in the equity, I don't think they ever really deliver on their timeline per se, right?
No,
like,
I would agree.
A handful of them that end up taking twice as long as you would anticipate. The return's still good, but yeah, I mean, like, your capital is stuck in that anyway. So if you're interested in development, and like same thing if you're buying a condo unit. I mean, I closed on some pre-cons 2 years ago that I had. My dad actually got them, but 13 years it took. Right, that was ground based too. Like, that wasn't even a high rise. Jeez. Some of these high rise, like so some of these high rise projects, you know, I mean, like, that right now the builders aren't even incentivized really to try and deliver as quickly as possible, because trade prices. I mean, I guess that you'd have a fixed bid, so it wouldn't really matter. But, like, you know, your cost environment is decreasing. You're hoping that you can stave off the risk maybe of failed closings. You know, there's like, so some of these guys, it's just like, if you've got your purchases locked in and there's a timeline in which you have to deliver, you kind of do it, but you stretch it out as much as possible too. So even the buyers are like, you know, it's like, oh, I thought I was going to get this in 2 years. It's like, I don't know, do you know any builders who have ever like actually delivered on time too? Right. So they're kind of a comparable product, I guess, in that regard, I guess is all I'm trying to say.
Well, the fuse to the bomb is only so long. The carrying cost on the debt.
Yeah.
Profitability flips at
Yeah.
some point.
No, that's a good point too.
Depends on what the cost of your debt is.
Yeah.
Well capitalized developers for sure. Especially if they had margin on the profit, but the situation's a little bit more dire than that right now.
For sure.
Yeah. Let's get into tariffs.
Yeah.
Let's talk about that. You posted something the other day. I went to
I stole that from you, actually, the 6% drop.
Yeah?
Yeah. I think, didn't you post it before me? I feel like you did.
Maybe,
Yeah.
yeah. We saw an economist yesterday, so we're actually part of the Waterloo's Home Builders Association, and we had a TD economist come, and he was talking about worst case scenario, what happens if tariffs come, and it's really sobering to understand that all the banks have already run the worst case scenario. They already have the models. They understand what could happen, and it's no joke. First of all, do you think it's going to happen? Do you think he's not playing around?
Yeah, I think so. I think that I guess the question becomes whether or not Donald Trump wants to be known for being America first and doing the tariffs, or whether or not he wants to be known for presiding over a strong economy. Because I think he will do the tariffs. He'll do the America first. He'll do the thing, and then there will be economic consequences that I don't think he doesn't sound like he's super observant of at this point. And I think that once those start to appear, he will probably quietly start allowing exemptions in the same format that they did in 2016 and 2017, without ever removing the tariffs per se, but allowing for the pressure to be taken off of potentially any inflationary scenarios, any trade deficits, any contractions in GDP that you might see in the U.S. or Canada. Because it's easy to say, oh, we're going to make Canada pay for this, but it's we're actually not paying.
We subsidize you.
Well, no, it's not even that part. Set that aside. It's the cost gets added to the goods that your consumers buy. Right. So it's actually the consumers that end up paying at the end of the day, right? It's it's saying development charges went up and everyone's
yeah, just passed down.
It's the builders have to pay it. It's do they? Because it's actually it's just cost push inflation, right? So okay, you could say the tariffs are gonna, or it's so mean to Canada, but it's it will suck for us, but it's gonna suck just as much for the people who are actually buying the goods, right? And then maybe they have to go replace that with a U.S. good, but the reason they're not buying that U.S. good currently is because it's more expensive than the Canadian version. So
massively inflationary.
Could be, yeah. I think so. So I think that if you end up with a kind of a stagflation issue, reasonable to expect a recessionary setup going on in certain areas of the U.S. economy. It could really be a bad setup. You look at certain metrics, just look wild to me, and then you add tariffs to that. It's I don't know. It could be pretty ugly. Yeah. I'll leave it at that. We'll finish with the tariffs, and then there's a couple more layers to it, but.
I definitely agree that I think he's more America first. His whole slogan is run on mega, right? So he's definitely very American first. And I agree. At first I didn't think he was actually going to go through with it.
I thought it was a negotiating tactic.
I thought so too.
Danielle Smith scared the shit out of me.
Yeah, you start to.
I knew he was serious from the start. He did it last time, but he just they got rid of it quietly. The tariffs they never went away, but there was 70,000 exemptions in 2017 for Canadian businesses, right? So.
I think that's where the next step that Canada needs to focus on is you have a guy in office who wants to do deal. The guy's literally wrote a book about the art of the deal. He's all about doing business, deals, right? Sure.
Big deal guy.
Big deal guy, the best deals. If
you've never seen a better deal.
The deals. Canada Prime Minister in office, and it doesn't matter who it is at this point, honestly. Someone who's, again, you have to have some, obviously Canada needs to be put first in a sense, but come to the table ready to do business, right? And have the mindset that you need to be able to set it up for a Republican government long term. Trump's only going to be in office for the next 4 years, but whereas from a Canadian government, there's a little bit of a more stretched and indefinite timeline. But come to the table with something that's going to benefit him in his term, but also, hey, look, this is also going to benefit your party long term as well too. And we're here to help support your side of the party. like I think he wants to do business, and I think it makes sense. I think Canada's in a really prime opportunity to have almost their own modern day like industrial revolution with the resources and our ability to bring some refinement back into Canada, and taking a look at setting up the pipeline and the GDP that produces. I mean, I think we're at a point now where like if someone is able to capitalize on that, there's a lot of good that can be structured and a lot of deals to get done that can benefit both sides of the border long term. It's just you have to have someone on Canada's side who's able to come in and do business. And Trudeau, out of all the things that people don't like about him, like the biggest thing is like people don't take him seriously. His negotiations aren't great. Like I can only imagine the conversation between him and like the tariffs will settle themselves, Trump. Like I mean, like I can only imagine like how the conversation goes, if there even really was a conversation, right? But like it's you have to have someone who can negotiate and has the mindset to work with a business guy like Trump. I mean, that's the other thing. Like Trump's not just a public figure. He's a sharp dude. He's run businesses. He's been very successful. So I mean, as much as he has that presence to him, like there is a mind there as well too. Like he is a very smart individual. So I mean, you can't just push stuff on him and expect to make party moves. He understands negotiating and what comes with that.
For sure.
Yeah. I would like to hope that Canada, in a push is going to come to shove, and whether or not we like the situation or not, it's going to affect us. For real estate investors, what does that mean if that does actually come into effect? TD believes that you're going to see a possible double-digit loss in value from where we're at now, and that's just in the GTA, centralized, and a significant double-digit drop in real estate sales as well. That is for 2025 as a whole, and then they believe that there's going to be a 10% increase after that in 2026 to rebound once we've kind of stabilized out the current situation. But does it affect our dollar? Absolutely. They believe that we would have much more aggressive policy rate decisions from the Bank of Canada. So, as an investor, what does that mean? Well, realistically, if capital is much cheaper very quickly, the ones who have the dry powder are going to have the ability to be able to make some generational moves. I think that there is an ability, if that does happen, to I don't want to say the word take advantage, because that's not what I'm trying to say, but like
capitalize.
Capitalize. There are opportunities that are going to show up for people who have liquid capital available to be able to acquire. We definitely go into a recession if that's the case, and recessionary times with very cheap capital for executors is kind of a recipe for acquisition, right? Like
For sure.
there are some advantages that are going to come with this situation that aren't necessarily completely negative to investors as a whole in Canada.
Mm-hmm. Yeah, I mean, it's like this. It's the setup that I've been droning on and on for 5 years, so I better be ready for it.
Like cost of materials is a big thing too. I mean, for as much as we keep talking about new units and new opportunities in Canada for lack of development, I mean, you have to be able to find a way to keep construction costs manageable, right? Like,
Yeah.
we saw what that looked like through COVID, and I mean, lumber was up like what 200, 300, 400% at some point. Like that's not manageable, based on today's rates. Even though the rates are realistic and not terribly high rates to begin with, but I mean, it only creates further issues if the costs are just that much more inflated, and we're already not on track as much as the government likes to say they're going to build millions of homes over the next like 10 years, but it's having those tariffs comes in, and lumber and steel and gas. I mean, the whole thing is a chain reaction, right? But we just can't afford to have that cost increase on construction pieces.
Yeah, I think Canada's economy's taken enough hits over the last little bit that like this would kind of just be the final nail in the coffin, to be honest. I mean, you've got population contraction, right? Which honestly I felt was organic anyway. Like I think that the Liberal Party put that policy in when
They front run it.
I think so. Yeah.
Yeah.
They did it with both, right? You could see it with international student numbers. You could you could see them rolling over. They put the policy in. Same thing with temporary foreign workers. They put the policy in. So I think that's just a similar setup to the 90s, where basically people left because the economy sucked. It's like, well, if you're going to have a hard life, like just go home and hang out there for a bit, and you came here for a better life, right? So if you're if it's going to be a hard life, just do it where you were before, and it's cheaper, you're closer to your family, etc. you can kind of already see that happening. So that's a lot of decline in the economy. Interest rates obviously putting a ton of pressure on it. Residential investment is toast, right? I don't know. Like this is, it's going to be tough. It's the last. It really
2025 is going to be great, guys.
Yeah. Well, it's funny. Like I remember when when the market first dropped, like Q1 22, right? People were like survive till 2025, and now it's like survive 2025.
Yeah.
Yeah, it's really just opportunistic capital or like almost like institutional level investment. When money will always move. When you have an institution or you have like a fund and those funds need to transact to be able to create a return, it unfortunately puts them in a situation where they have to continue to transact. But a lot of the people who are in like pre-existing debt that need to restructure debt, like there's always going to be money moving around. But yeah, the retail component of real estate investing is completely dried up, and a lot of it was exacerbated by either prom notes or tons of just free liquid money rolling around. I don't
Still is, to be honest. I think there's still a lot of borrowed cap for sure.
Well, yeah, on the LP side for sure, but I don't necessarily see the access to that type of capital still.
I don't think there's as many people. Obviously, there's a population of people who got hit in some capital loss with COVID, but I mean, how many mid-sized projects do you see where there is someone injecting some sort of prom note or borrowed, like publicly fundraised capital op or GV? Like, there's still a pretty decent majority of them that are raising down payment or equity on the mid-level side.
Yeah.
I think there's a lot of like privately raised capital.
I mean, if you're a well-capitalized buyer in today's market, you don't really you can get to 95 without needing to do that anyway. So I mean, look, if you have to raise beyond 5% equity, you probably shouldn't be doing deals. I don't know, realistically, right?
Yeah, absolutely. I mean, the new construction stuff, CMHC changed some rules in regards to lease-up requirements, so it's no longer 5% anymore. It's more like 25 or 30% that you really need to be able to make it happen now, which is interesting because CMHC kind of has their finger on the pulse of everything, and they can just move like a rule around. It's like, oh, we're not going to change to 95, but like you now need 30% actual capital to get this done because we're not giving you the rest until you lease it up. So. I think CMHC is playing games too. A lot of people. There's we can touch on that really quick too. It's just like CMHC in general and the debt that they provide to the market, and really they're the lifeblood of everything that's moving right now. There isn't necessarily a ton of development business going on that doesn't have CMHC attached to it on the purpose build side, and purpose build multifamily is the only thing that's penciling right now in the country. CMHC as a whole has been the backbone of really the last 2 or 3 years of the Canadian economy, and what they're doing in regards to changing rules. I mean, if anybody watches our videos, I feel like every other video is an update on these rules that change. Just keeping up to date on what that looks like. But the dependency, where I was going with this, was the dependency on this type of capital. Like, do you foresee that like this is just going to be the way? Like the federal government is just going to single-handedly keep the backbone of development up? Or like, is there going to be another way to be able to continue to develop in this country?
It's a good question. I think that that's the intention currently. Probably is for it to be like a 30-year program, similar to like the original form of the National Housing Act, right? Like the MERB program was 20 years, right? I think there's a lot of greed and there's a lot of speed. Honestly, like it materializes a lot quicker. Like I think we're already at the point where it's kind of coming off the rails a little bit, right? You got these like Toronto pre-con investors going like levered long into markets that they've never like even analyzed in
Alberta.
Yeah, that are like that are overbuilt. Like you can see them being overbuilt. You look at the last city that they blew up, and it was 2%, went from 2% vacancy to 7% vacancy for that asset class, and everybody's experiencing what you're saying, where they do the holdbacks on the rent until they've achieved their rents, right? Or achieve their pro forma rents or vacancy, and people are just stuck in these deals. So there's such thing as like too much of a good thing, and I think that we're already kind of getting close to that. And combining that with Pierre basically being small government and wanting to gut the CMHC, like it's plausible that the party could end pretty quickly, to be honest. Like I think this might not be around in 4 years in its current form. But I don't know. It's like, at this point, so many elections and such a big swing politically from left to right in both the U.S. and Canada. I think it's very hard to imagine like what is the right potential outcome. You kind of just have to try and narrow down like the range of potential outcomes, like what could happen. And to me, I think that those are basically, unfortunately, it's like either it continues almost exactly as it is, maybe with like a little bit more economic sensibility wrapped around it, which sounds like that's already taking place from CMHC's part, or it basically just gets completely collapsed over a X year period.
I just feel like his entire party platform is build more houses, make things more affordable, incentivize the developer, the private developer to build these homes. And just for somebody who finances this stuff, like it is the only option at the moment. Like not having CMHC as a way to be able to build purpose-built rental in this country would, I think, be counterintuitive to really what his whole party platform is.
Yeah, I would agree.
Build more units. I think we've heard rumors. Obviously, there's lots of rumors that what's he going to do with CMHC? Are they going to be buying these bonds? Is this going to be something that's going to stick around?
Well, they definitely need to figure the bond, like the pricing of CMHC needs to be figured out. I mean, like you take a look at CMB over the last like 2 weeks, like
30 points.
Your delta on the swings is like 60 points to 80 points sometimes. You're just taking a look at like the range of swings, and it's like, you wonder why a lot of big guys are hesitant to develop. And it's like, well, you can kind of squeeze out some projects on the mid-level size with the swings, but like when you're swing on like a $10 million plus $30 million like development, like those swings like make or break projects, right? So I mean, they definitely need to figure that out and how they're pricing it.
Is that a consequence of like the spread capture program? Like, because the government's buying 50% of these bonds, basically?
I don't think so. I think it's just like in and of itself, the bond markets are way more sensitive to just any sort of movement in economic factors right now. Like,
but is that a movement in like the 5-year bond yield?
The 5 and the 10 year. We're talking about the CMB, not the GOC.
Yeah, but they're selling, like the government's selling GOCs to buy CMBs, basically.
Yeah.
Right?
I mean, realistically, and you take a look at it, like the CMB has been propped up by the government and in return, like taxpayers. Like that's what I felt when they first introduced that spread capture program. I was like, this is like de facto yield curve control, which like just creates a ton of vulnerability on CMB basically being pegged to the 5-year now. But then by doing that, you also create like a not so shiny product. Like you want people to come in and to invest, and it's like, okay, who's investing? Well, the government of Canada. Okay, who else is investing?
50% buyer.
Yeah. Nobody. Yeah. Oh, so you guys are backing your own mortgage bonds, and you want us to come in and invest with it, but you have no other but there's no attraction there. And then you take a look at how volatile it's been lately, and again, as an investor into something like that, how are you able to calculate your returns and average that out if you have hey, today we're buying bonds are 3.4, yesterday they were 3.1, tomorrow they're 3.8. How do you how are you really able to sit down and put that out on a spreadsheet? It's pretty nuts. No.
Yeah, no, it's too, you're right. Yeah. I mean, this is one of the problems with Canada.
Even on the consumer side of things, like a developer, the equity position you're going to have in your property, or like a rate lock and buy down situation, we're seeing, if you have 40 basis point swing from, where you underwrote the deal at on your max rate to where you're closing at, and you have $150,000 buy down or more.
I mean, you look at the big guys,
millions,
$2, $3, $4 million and buy down.
That's no longer, that is no longer a viable project. Mm-hmm. The stability or the instability of these CMB movements, I feel as though it's almost like stock trading today. Every time I take a look at the CMB, something's changing. It's so sensitive to the market in and of itself, the job markets, the CPI data. I feel like everything is just standing on eggshells currently. Everyone's just knee jerk moving based off of what's happening next.
I think what would really be interesting with it is okay, if it's too volatile for the big guy to get in and want to do stuff, and there is some talk about CMHC limiting smaller loans in more remote areas. So if you lose whatever bottom percentage that is, and you're losing the big guys, where how much of an effective range does CMHC have at that point if you can only the $5 million deals are penciling out because they're not doing the smaller stuff, but the big stuff is too risky and too volatile for the pay downs. And I mean, it's also look at how the buy downs work, right? I mean, each lender is slightly different. There's some lenders that allow you to buy down out of equity in the project, but I mean, realistically on construction, you don't really
It's
have
cash in.
It's cash in. So I mean,
Yeah.
it's it's not like you're turning over an apartment building and you're pulling out equity and you can just leave some of that back in. It's like just pure cash out of pocket at that point. Like it's so. I don't know if they do start to cut out some of the smaller rural stuff, and it's not like they're going to lose at least I don't think, the $2-3 million deal in like Kitchener, Waterloo, London type stuff. It's going to be like, the $1 million Red Deer, Alberta, or smaller Chatham stuff maybe. So I mean, it'll be interesting to see, but that's definitely a conversation that I've heard from the lenders in terms of CMHC's already brought that as like a table talking point, cutting small riskier loans like that. So
Yeah. 2025, we just got in it. It's a whole lot of uncertainty in the market right now. There are a lot of questions for a lot of people. Do I deploy capital? Do I not? If you were to leave our guest today with a piece of advice, something that you would want them to take with them for the rest of the year, what would that be?
let's make it positive.
Yeah.
Yeah, guys, we're bullish on real estate.
No, yeah, I think, like you mentioned, there's ways to capitalize on a bad market, and I think that there's going to be a ton of opportunity. But I think it's important to be aware that that opportunity comes at like a very, very, very steep cost, and that cost is people suffering. Right? It's people losing money. It's people making decisions that they made in the past, or coming home to roost for decisions that they made in the past that they might never financially recover from. And so it's easy to kind of like cheer on, like the blood in the streets moment when we all get to go out and start like, buying these discounted assets and stuff, but just like remember that there's another person on the other end of that. Like I'm among the people who don't have a lot of sympathy for like speculators and the people, but they're in the process of learning what they did was wrong, and don't laugh at them, and I think the whole thing boils down to me is like just create value, right? As a buyer of distressed assets, which is probably what you'll be buying in 2025 and 2026, 90% of the time you can create value just by being a buyer, like honestly. And so don't I think we're going to be in a market that will be very favorable to buyers for probably 12 to 24 months. Don't rush, don't get too fired up. Don't laugh, don't laugh at people. Don't ridicule people who got into ridiculous scenarios. Be willing to work with people, be willing to find structure, be willing to make compromises, and I think then you'll kind of emerge better off than a lot of the other people who are just kind of sitting there salivating and looking for the blood in the streets. That would be my only thing, is just like get out there, work your ass off. There's going to be really good deals, and be nice to each other.
Yeah, be good, have good intentions. Good things happen to good people, and things grow.
Yeah. Most investors, you were like 1 or 2 months from your project being caught in the same kind of like interest rate storm that a lot of other people were caught in.
I've ran the margins pretty tight before. Like, I don't know, you look at like Elon Musk talking about like there's a period of time where he's like, like Tesla was like fully bankrupt. Like
Day of waiting for funding,
Yeah.
Like, I don't know, it's any of those situations could have been any of us, right?
100%.
Absolutely, yeah. Guys, if you guys enjoyed this, Dan and his partner Nick do have a podcast. We talked about it earlier. If you guys liked what we heard today, go check them out. They drop a ton of information up to date all the time. So if you guys are looking for contact information, it'll be down below. Best way to contact you is going to be Twitter?
Yeah, Twitter probably, or Twitter, Instagram. I don't know, just like whatever you're on. I try and be on everything. I would say TikTok, but it's banned, I think, soon, starting Sunday. And I actually don't even know how to check my messages on TikTok, so don't contact me there. Everywhere else, it doesn't matter.
Amazing. Well, appreciate time coming on today. Yeah, it was great. We'll definitely look forward to having you back.
For sure. Thanks for having me.
Sweet.